Yo, and welcome to this edition of Owl Eyes on Base DeFi. Today is episode 10. This is the 10th episode, 10th week in a row of covering the latest and greatest stuff on Base DeFi. We look at liquidity pools, yield farming, and then my wonderful co-host gives a breakdown on different protocols. So without further ado, let's pass it over to the man, the myth, Crypto Noah. How are you today, my friend?
Man, I'm on 10 because this is episode 10. Feeling good. It's TechCrunch here in San Francisco, so I've been going to meetups and events literally every day this week, and I'm going to head out right after this, but I'm doing good, man. Excited to cover some good stuff. Today we're going to be talking about understanding DeFi revenue models, okay? What goes into it, what you should look out for, how you can make money, all these different things. And we're going to do a soft fundamental deep dive on the Ryft project recommended by my good brother and co-host Basejunkie. We're going to talk about how they make money as well and how they're going to actually help DeFi. But for the reason why you guys are all here, for the peak, the swag. I got on my Aleph Cloud DevCon shirt, got this at ETH Denver. Some cool graphics. I feel like it kind of matched the vibe of the Ryft website. On the back, it says the Web3 Super Cloud. So yeah, thanks for coming, guys. We'll see you on the next one. Basejunkie, how you doing?
Man, I'm doing well. I'm actually right in the middle of moving house, so new setup today. But I am fully kitted out in Fireside head to toe, representing my Fireside tee. But man, I feel like Dev Connect, that seems to be where it's at, or even ETH Denver. Like some of these events, you are getting all the swag. Like I feel like I have an endless wardrobe, but the fact that we're 10 weeks in and I'm starting to think like, I'm running out of swag shirts. But you
nowhere near, bro.
You are going strong.
Bro, I had two shirts on my bed. I'm like standing there for 5 minutes, like I'm about to go out to a club. Like, man, should I wear this one? Should I wear this one? It's like this one matches the vibe of the Ryft website, so I'm like, oh, we'll just go with this one. So here we are, man. I got stay for a while, guys. I won't run out for a long time, and then there's gonna be another event coming up, so we can do this every week. I don't think I'll ever run out.
That's one of the perks of living in San Francisco.
Yeah,
I mean, not too many events in the south of Portugal. I mean, it could be if it's a paddle event, yeah, like you got those every single week. But crypto, where the swag is flowing, that is few and far between. So, guys, this is the show where you come for the fashion and stay for the DeFi.
Yes, sir. Whoa. Well. I know you're moving. I know you're super tired. So guys and gals, we're going to get right into this. We always try to present something that helps you understand the stack, understand the fundamentals. And then, like we said, we do these fundamental analysis. We've done OpenXAI, which has been doing pretty well lately. They've been doing some cool stuff in building. We did Syndicate. We did Zora. And I believe that's it, unless I'm missing one. So today we're going to be talking about Ryft. But first, we're going to be talking about understanding the DeFi revenue models, right? It's one of the most valuable yet understood areas in all of DeFi, especially for people trying to separate real yield from Ponzi-nomics. Because you have a lot of protocols that launch and they have these incentives and people get them confused, right? So basically the goal is to help you understand where the yield actually comes from, how protocols make money, and how to identify sustainable DeFi opportunities. Especially on Base, because this is the Base show. All right. So the core idea is basically that DeFi is just financial plumbing. Okay. So it's always important to look at these DeFi protocols as businesses, actually, just without a lot of times CEOs or offices, even though, Uniswap's a DeFi protocol. Hayden Adams, the CEO, but it's a little bit different. They still generate revenue by charging fees for useful financial services, whether it be swaps, lending, borrowing, liquidations, insurance, etc. And that's the common comparison. Because if you look at TradFi, it's 3 ways to get a real yield: so borrowing and lending, market making fees on exchanges, and insurance premiums. It's the same thing in DeFi. The only extra one is getting the yield from staking on a blockchain's staking contract, like the Ep.10 beacon chain, etc. Okay, so just to give some examples. And Basejunkie, if I'm getting in the weeds or anything, feel free to cut me off anytime per usual. So when you swap tokens on Aerodrome or Uniswap, a small percentage, usually 0.01 to 0.3, goes to liquidity providers. When you borrow on Morpho, part of Coinbase's DeFi mullet, part of the interest you pay goes to the protocol's treasury or stakers. And then when you mint or bridge assets, protocols often charge gas or protocol fees that actually become recurring revenue. Okay, so the difference between TradFi and DeFi, in TradFi, the money goes to banks and shareholders, and DeFi is distributed to you, the users, the token holders, and the liquidity providers. Okay, so we're going to quickly cover the three main revenue models. So the most profitable way we always talk about is trading fees on DEXs. So this is collected every time users swap tokens. You have a fee for swapping the token, and then you also have a flat fee, right? And Basejunkie and I are always foaming at the mouth when we find a 1% fee tier pool, because you make a lot more, even if the volume to TVO ratio in the pool isn't that much. It's shared with the liquidity providers, like I said, or the protocol stakers. We already gave the Aerodrome example. So this is like cash flow, borrowing and lending, same thing. Morpho, they earn yield by matching lenders and borrowers directly and taking a protocol fee for, bringing them both together. And this depends on real usage, because if people borrow or trade, farm, the fees are real. But if they borrow to farm unsustainable incentives, this is when you want to beware, right? And this is when DeFi Summer started back in 2020 with Compound, actually. And you can go on Compound and you can stake your Bitcoin, your Ethereum, your USDC. But what started off DeFi Summer is that they started to pay you not just in the asset that you were staking on, you actually started to earn in comp tokens, and the yields were pretty high. And then every protocol was like, oh, that's a good way to incentivize it. It's that Rick and Morty meme. Everyone was like, son of a bitch, I'm in. And then everyone just copied it. So going on to that point, let's talk about real yield versus fake yield, okay? And this is where most newbies actually get wrecked. Okay, so real yield is, like we said, it's revenue generated by actual users paying fees, such as DEX trading fees, liquidation fees like on GMX, or lending interest, right? Fake yield are rewards printed from token inflation, right? So Compound, when they kicked off DeFi Summer, this was fake yield. The real yield was the yield that you earn, which is way smaller from staking your Bitcoin, staking your USDC, and you're getting paid in Bitcoin, USDC, whatever you staked in. The fake yield was them paying you in comp tokens, because they create these comp tokens out of thin air and they just pay you in them. And then eventually everyone sold them and you accumulated all this yield for nothing, while you made Compound a lot of money for facilitating the yields. But they were paying. It works if you take profits, but if you just keep accumulating the token and it dumps, it's almost like getting paid in cows and you're planning on making all this stake and they all get sick and die. It was for no reason. Okay. So why does this matter now? Okay. The smartest DeFi investors, and the way to win at DeFi, they're not just chasing high APYs in form of like token incentives. They're accumulating positions and protocols with real recurring cash flows. Okay. So I think on base, I think the future is going to be about revenue sharing and fee distribution models that kind of resemble dividend paying stocks. So when users and creators share in a protocol success, you get a sticky ecosystem instead of speculative ghost towns. Okay. So this is why we're bullish on projects like Zora, projects like Aerodrome, because everyone wins. On Zora, you get your creator coin, you have to have skin in the game and actually buy it. But also when people are buying it, you get a piece of the transaction revenue. Same thing with Pump Fund, same thing with Aerodrome. So that is the Ryft RAF on DeFi revenue models.
I like how you said Ryft RAF.
That was from,
yeah. Definitely dig it. I mean, that's it's valuable information. I think everybody can learn something from that if that's the first time you've heard it. Now, that particular those three revenue models, was that tied into Ryft?
No, that's just in general, but Ryft does tie into some of those. Those are the three core ways to earn from a financial product in compared to TradFi as well. Borrowing and lending, swap fees, and insurance premiums. It was one more, I think. Liquidations as well. Yeah, if it's not that, if it's creating a new token, you just have to think to yourself, if they're creating this new token, it's like printing money. The value of the rest goes down unless everyone holds, but that never happens, at least for not an extended period of time.
Yeah, very good. I think we are seeing more infrastructure plays, and if the token has these sort of mechanics, you can see like the viability of it long term. Otherwise, it's almost like a meme coin. If there isn't a way for it to be generating extra money, or if the token itself isn't the settlement layer, then it's like, what's the purpose of it beyond just speculating that the price can go up? I'm getting more and more familiar and fond of these plays where there is actually like these mechanisms to generate fees.
Yeah. And since we're talking about the base chain, I'm gonna share my screen and we'll look at like the revenue that Base is generating. We're gonna check out Dune Analytics. This is a free website here. And you can see it gives you all the metrics, right? So you look at the total value bridged, and this is like daily or almost daily. So the total value peaked in June, and then they had that whole sequencer issue, and things kind of dropped off. But they're still getting billions of dollars bridged on pretty consistently. Billions of dollars in altcoins bridged on, and millions of dollars in stable coins bridged on. You look at the net flow, you got ins and outs, but overall you have more coming in than out. If we scroll down to cumulative fees and revenue, you can see that the revenue has just been consistently rising. This is Base as a network, right? One of Coinbase's many revenue streams, right? And then you can look at their weekly fees and revenues here. It's been rising. You can also get this stuff on DeFi Llama, but I like how they have it siloed here and not all stacked on top of each other. You look at the daily new users on Base, and while it has been going down, the cumulative users have been sticking or rising, which means the people who are using it are continuing to use it more and more, right? Same thing with transactions, but the transactions have actually been rising along with the cumulative transactions. So that means new and older people, not old in age, but older in terms of how long they've been on the chain, are continuing to use it more. Daily active users, it's kind of been sliding off a bit, but it's still really, really high. Looks like the support area is around this over this $1 million mark. But this could be considered a vanity metric because you can have the same user, but they're bridging on more funds, as you can see here, right? So just because that's fallen off doesn't mean the same users aren't putting on more money. I've been putting more money onto Base, to be honest. So if I'm doing it, I know other people are doing it. So yeah, that just kind of gives you a glimpse as to how Base is actually making money. And, it's good to be invested into something like this in terms of the usage, like using the network, not just because we think we're going to get an airdrop, but it's just like, if they're making money, they're going to be able to continue to sustain themselves and do cool things like, invest into creators on Zora and, make acquisitions to, make the company better, essentially.
Yeah, bullish. I mean, it is well and truly Base season. I think there's something in the air, and seeing this, I mean, as you mentioned, like the charts don't paint the full picture because the users, I mean, you and I, we both only count for one user each, but as time goes on, the more time we're spending on Base, the more we're bridging, the more we're focused, the more we're building, and it still only counts as one. So yeah, definitely bullish.
All right. Well, now we can go in. If you didn't have any more questions, we can go and go into this riffraff here.
Yeah, honestly, like I really want to hear what your takes on Ryft. I've had multiple conversations with Jordan Charters, the founder of the project, and I think, I mean, his eloquence and the way that he puts this, and like the scale of what is possible, and the new technologies that they're pioneering, it's like, yeah, I'm very fond of this project. So I definitely want to get your take.
Let's start off with what is this project? So they basically offer a protocol and app suite that lets creators, projects, and communities convert tokens and assets into hybrid NFTs. NFT stands for non-fungible tokens, and basically an NFT is it gives any product, whether it be physical or digital, a digital identity. Okay, a fungible token is like Bitcoin. One Bitcoin is equal to one Bitcoin anywhere in the world. Non-fungible mean it's unique to itself. Like you have all these different Bored Ape Yacht Club NFTs. Each one is different. That's why it's an NFT and not a FT, if that makes sense. So they're programmable, composable assets to combine token utility and NFT tooling with the focus on base and multi-chain support. They're an omni-chain hybrid NFT solution. They can be supported on 70 plus chains, which is really good. All right, interoperability has always been a huge problem in crypto, and we are still in the dial-up stages of the blockchain to where all these different chains can't talk to each other. And it's kind of like back in the day, same thing happened with the internet. If I had a Yahoo and Basejunkie had an AOL, I couldn't email him until there was an interoperability protocol. And now it doesn't matter if I have a Gmail, Yahoo, Hotmail, I can email anyone with any email because things are interoperable. We still have a ways to go with that in blockchain, and they're trying to help with that in this sector. This composability layer, it routes protocol fees back to creators, and it enables new tokenomics use cases. So now let's talk about what problems they're solving. So 3 main problems. The first one is that traditional NFTs are static and siloed. So most of them are just like media pointers, JPEGs, plus metadata. So if you look at a Bored Ape, you have a picture and then you have a metadata of this kind of shirt, how many shirts there are total, when it was created, just basically things like that. And that limits real financial utility. Like it's no easy way to attach other tokens, yields, fractional rights, etc. So Ryft is aiming to enable hybrid assets that combine fungible tokens, on-chain rights, and NFT identity into one composable object. Second problem they're solving, liquidity and utility fragmentation. So projects want to make assets liquid and composable, basically be able to lend out, use as collateral, and earn yield, but without losing provenance or ownership. So Ryft's wrapper idea actually tries to make arbitrary assets work inside NFT flows. And the third thing is creator monetization and tooling friction, and we're going to get into some use cases. So many creators lack simple tooling to create dynamic assets across chains, but Ryft provides this wrapper UI so that creators can launch collections that embed extra token functionality. Why does all this matter, and what does it actually mean? So imagine if you can take any ERC20 token, LP token, which is the token you get back from providing liquidity in a pool, or a stable coin, and wrap it into a hybrid NFT that preserves both fungible economics and NFT economics. Because the cool thing is that you can unlock new different things. Like think about, like you have a Bored Ape in your wallet, or a pudgy penguin, or any kind of NFT. The only thing you can do with it is use it to get inside of some group or some Discord channel, maybe get inside of some metaverse thing, which is cool, or sell it for a profit or for a loss. But you can't do any DeFi with it. And we're getting to the point where NFTs and DeFis are starting to have babies. Because imagine if you could take your Bored Ape and instead of it just sitting in your wallet collecting dust, virtual pixie dust, you can stake it on Aave and get paid a yield from it. Or you can borrow against it, right? And you're probably wondering, like, how are you going to borrow against it if there's no market for it? Well, if you have a rare Bored Ape like yacht NFT and you go on, any NFT has a floor, right? You have a floor. And if it's an NFT that's representing some kind of hard asset, it has a market for it. So it's going to have a price. So the price of it is going to be tied to your collateral, just like borrowing against ETH. ETH has a price. Bored Apes have a price. Assets have a price. So being able to borrow against it works. And if you guys remember back to our couple episodes ago, we were talking about how important it would have been, or how cool and beneficial it would have been had you been able to use S&P 500 stocks, or even stocks in general, or treasuries, tokenized treasuries on chain as collateral. we wouldn't have seen as deep as a bear market because people's collateral was tied to the asset that they were speculating on. And then anytime that's the case, everything's just going to go down. It's a house of cards. Okay. So that kind of thing is cool. That's really cool utility. You're basically allowing NFTs and DeFi to like work together instead of keeping them siloed, because yeah, it's cool to have a Bored Ape in your wallet, but if I can't use it for anything or borrow against it, then it's not as useful. And it would raise the floor for all these NFTs too, because they now inherently have utility in DeFi. Okay. So now, how do you make money on Ryft? Practical way. So as a creator, you can mint hybrid collections, right? So this includes revenue bearing tokens. Like let's say you want to charge for something. Let's say you're a streamer, right? You can mint an NFT, and when people buy it, it has a streaming payment or share of future royalties, right? So the monetization is that you mint fees plus ongoing royalty flow plus extra protocol rewards if offered. What you want to watch out for is adoption, marketplace liquidity, and whether the builder charges ongoing protocol fees. The next way, a collector, a liquidity provider. So you can buy Ryft and in the future when people are offering. I'm not saying right now necessarily, but I'm just talking about the possibilities that it opens up. You can buy these Ryft NFTs that actually embed yield. Okay, so it can contain a yield bearing token or a share of an LP. You get NFT provenance plus economic return, right? So like a lot of people may not know this, but Uniswap has been using NFTs ever since they went to concentrated liquidity. Anytime you enter into a concentrated liquidity position, you're minting an NFT on chain that represents your tokens that you pulled together. And it's kind of like back in the day, if you look on any dollar still today, it says US promissory note. And what that means is a promise to give you back your gold once you give me back this dollar. The dollar is actually a receipt. It became a currency. It's the same thing with LP tokens, right? If you don't have your LP tokens, you can't go back onto the DEX to get your liquidity, just like you can't get your gold back from the bank back in the day without your dollars, okay? So that's another way. Liquidity provider, market maker. So you can provide liquidity and earn fees, monetization, you swap, watch out for impermanent loss, things like that. So, you know, if there's eventually going to become a world where instead of just swapping for NFTs and things on OpenSea, there's going to be a DEX for swapping NFTs. So if you're providing liquidity in NFTs, you want to look out for impermanent loss. It's going to be a lot of risk. A lot of people are going to lose money in the beginning, but just like with traditional LPing, things are eventually going to make sense. And then as a builder or integrator, like we talked about, you can integrate them with things like Eyez and Morpho and other money market platforms and have different token incentives and things like that. And this project did say that they are going to do an airdrop. So it'll be cool to get involved early because you'll get to earn some tokens. So how does Ryft make money as a platform? Since we just talked about DeFi revenue metrics and things like that. So 4 main ways. 1, mint and wrapper fees. So you guys know we have Ethereum and wrapped Ethereum. A lot of people don't really know what the difference is, but wrapped Ethereum is basically a version of Ethereum that can work inside of smart contracts. Native ETH doesn't. And that's why when you look on DEXs and you look at pools, it'll say ETH, whatever the asset is. Now, sometimes you have to convert it to ETH, or back in the day, you had to convert it to wrapped ETH before you got into the pool. But now they have it so that it seems like you're using native, but it wraps it for you immediately. It's kind of like DeFi is space and the wrapper is your astronaut suit. You can't breathe without your suit on. So you need to have wrapped ETH in order to do it. And this is kind of the same concept here. So they charge, you can wrap ETH for free. You pay like a small gas fee, but that's it. But here they have a wrapper fee. So small protocol fees to mint or wrap, right? And it's explicitly showed on their app. They have marketplace fees and royalty processing. So a cut of NFT sales, feature drops for curation, kind of like OpenSea. And then enterprise tooling and SDK. SDK stands for software development kits. So a subscription or integration fees for projects that want custom Ryft behavior. And that is broken down in their docs. And the last one is token economies. So Ryft governance utility could capture value if protocol fees are token bonded or used to bootstrap liquidity. But again, explicit tokenomics weren't necessarily publicly detailed, and I wasn't able to find a token except for one on Solana. But is there a token on Solana, Basejunkie? Do you know?
A Ryft token?
Yeah.
Currently, it's pre-TGE.
I thought so. I was like, I didn't think that was theirs. There is a Ryft token, but I didn't think it was theirs. Okay, so cool. So last thing here, and we'll wrap up. The risk and the red flags, because DeFi is risky. You know, you can. I feel like I sound like the bankless guy. DeFi is risky. Crypto is risky. Ethereum is risky. You can lose what you put in, but we are going west. But the risks are, you know, smart contract risk. You know, wrapping. You could find a hole in the armor, and then your oxygen is not working, and you can die. That's an analogy. So you have like this wrapper complexity, liquidity risk. This is a big risk with NFTs because with fungible tokens like Bitcoin, you know, everything's equal to everything. But with just one thing, if people don't desire that one thing, and this is why a lot of people are sitting on a lot of NFTs because the floors drop. Sometimes it can be tough to have liquidity for one like item, right? And then obviously marketing versus project maturity, they have to actually market this thing so people like it and, you know, want to keep building. And then I would say regulatory risk, but the regulatory climate has really been opening up, especially here in the United States. So yeah, that is my Rift Raft on Rift.
Hey, I mean, that was a great deep dive. I mean, to be honest, I think right now the website is just focusing on the NFTs, so I wasn't able to show too much about that. But it's always good to hear like how users can make money, how they make money, how they going to be sustainable. What was your biggest like takeaway from doing this research on Rift?
So if you go on their website and you hit builder, they make it really easy to do it. You don't have to be a dev to do this, all right? So you upload your JPEG, you select the chain you want to mint your NFT on, you upload the collection name, the description, max number, the fee, the wrapper fee receipt, the URL, and all these different things. So the biggest thing, I always like to say, like, markets create new markets. Like, let's say I want to have an NFT that represents something tangible. That tangible item is going to need to be stored somewhere safely because, like, it doesn't do me any good if, like, let's say I make a product. Let's say I make headphones, right? And I want to sell NFT versions of headphones that you can wear in the metaverse because they look cool. This is just an example I'm just thinking of. But you actually hold the real headphones because they hold value, right? This can be gold, it can be whatever. Whoever's storing those headphones, they need to be kept safe because what if someone breaks in and steals them all? What happens to my NFT? You know what I mean? And I know there's a company that like does this for watches. They sell they tokenize watches so you can own like a part of a Rolex or a part of a car and things like that. And they have everything stored in this place, and they have it insured, and they have security so that if it gets stolen, it's insured. They're able to get a new wallet, right? So things like that have to be sorted out. It seems like right now it's just for like NFTs on chain and like just digital products, but eventually we're going to live in a world where, like back then, if you compare the internet to blockchain, the internet, people thought it was just going to be used for marketing, but it was actually it assisted in your distribution, right? Like you can have all your stuff online, your orders and things like that. It wasn't just for marketing. And now we don't buy from a company. Like the first thing we say, like, what's your website? If a company doesn't have a website and online presence, we're probably gonna think they're a scam. In the future, companies that are selling luxury items, luxury goods, especially things that belong to former celebrities, things like that, we're not gonna buy them without an NFT attached to them so we can see like the life cycle of how it came to be so that we can verify its legitimacy. So there's going to have to be a way to where eventually these real world products are how we're verifying where they're at. They're safe, you know, monthly attestations, just like USDC and USDT have to do to verify like their holdings and their ratios and things like that. So that's the next thing that's going to have to happen. So I'm going to keep my eyes on this project and see like, you know, how that's looking. But right now it just seems like they're doing like digital NFTs. Because when I looked at the NFTs that's on there, You had like some scary cats. I saw something on there called Cocktober. It was like a fucking jack chicken.
I think the NFTs you see on there, it's all part of the. They're doing a bunch of collaborations in anticipation for Halloween.
Okay.
So it's a bunch of different projects submitting stuff for Halloween, and then I think they're looking to TGE next month. I know Jordan's talking about it a lot on different spaces.
Have you heard anything on like how to increase the chances for the airdrop? Have you done anything?
Not really. I haven't got any alpha there. I think just engaging with the protocol, minting some NFTs, just playing around, just doing what's possible right now, build up that digital footprint.
Okay, fair enough. Yeah, Halloween is right around the corner, man. It seems like I was just in Portugal and it was summertime. Crazy.
Dude, I saw Santa in the shop today. Like not the Santa, but like it was like an animatronic version. I'm like, what the heck? Like, wasn't it just summer?
Like, can we get through Thanksgiving first? Jeez.
Yeah, like oh man, like Mariah Carey. If I hear her before December,
Oh
I'm
God, please shoot me.
like come on, like it's just like guys, give it a rest. Like get back in your cave, Mariah. Like come out December the 1st.
Seriously, man. Okay. Well, speaking of Halloween, let's look at some of these scary yields. We can cover what the liquidity pools have been doing.
Right now, the markets are a little bit turbulent. How are your pools doing this week?
Great, actually.
Yeah.
Yeah.
Are you still printing with the Zora pool?
Yes, I am. Guys, also join our free community. I called out Tipper back at 7 cents. I just want to show this real quick. So anything that we recommend that someone, a buy call, we have a take profit sheet that shows all the levels where we're selling and everything like that. So I made a buy call out to Tibber, and I'm saying this because I'm going to talk about my Tibber pool as well. We made a buy call out to Tibber back in July when it was 7 cents. And literally yesterday, we hit our first sell target, right? 7 cents. It went all the way up to 42 cents. So our community hit a 600% gain from the initial recommendation. And the cool thing is that because of liquidity providing, it ended up being more than a 600% gain if you were taking your rewards and stacking Tibber. And it has been October this month. I haven't even been calling it October. It's been October. While everything has been going down, it seems like Tibber has just been continuing to rise. So I'm going to pull up this chart, and then we're going to look at some. So this is Tibber USDC. I called it out in July when it was 7 cents, like right here.
Beautiful.
%. Yeah, this chart looks great, and it looks like it's starting to consolidate on top of this channel, and it's probably going to start to, well, in a perfect world, start to do something like this and form a new channel on top of this one, something like that. But I'm super bullish on this project. It's a link to join our free community in the stream comments where you guys click the stream to scroll down. It's a link to join for free. And we do send out our weekly profits from every week. So if we go here, I made my first sell from 3 months ago when I originally got in but it was more than 600%. Because like when we first started farming Tibber as a community, it was paying like 2,000% APR. Now in my ranges, I'm getting almost 1% a day here and 188% here. Let me refresh so we can make sure we're working with current data. So yeah, it was just $4.99. Now it's $5.33. So before I started this show, while I've been on the show, I've made almost $100. So that's cool.
That's what's up, man.
Yeah, man. So it's been in this one for almost a month, 29 days, and I've been able to make $2,709 in passive fees, and in pooled assets in the capital gains, I've been able to make 5K because my range is really wide. So when I initially got in this range, it was down here, but as Tibber is going up against ETH, it's selling Tibber into ETH for me, and now I have, there's impermanent loss everyone talks about, but there's also impermanent gain that you get. Okay, and that's what we've been able to get here.
Just remind me and everybody listening, what is impermanent gain?
If this is Tibber USDC, right, and let's say this is my range here. If I go down and it goes out of range to the downside, it's a limit order for the underperforming asset. So if this is Tibber USDC and I go out of range to the downside, I'm going to be in 100% Tibber, and the price I pay is like I lose more than I would have lost had I just held USDC, because the USDC holds its value. But now the smart contract is going to limit order buy all Tibber, and now I'm in 100% of an asset that's down. But this is why we tell people never provide liquidity for two assets you wouldn't hold on their own, because impermanent loss can fuck you right on good, right? That's impermanent loss, and it becomes impermanent if I sell here. It could come back in, and now I'm back to break even. When it comes back inside my range, I'm back to making money. Impermanent gain is the exact opposite, to where if it goes out of range to the upside, I'm in 100% USDC, but I'm in more because not even including my fees, but I'm in 100% USDC, and it took profits in USDC, and the price I pay is foregoing opportunities because I would have made more had I just held Tibber. But this is why I have a bag of Tibber that I just worry about price appreciation. Here I'm just worried about cash flow because I've been in this pool since July. I've made well over 100%. So I'm in a risk-free pool, and now I was able to sell even more. I had like almost 50% more Tibber because I was constantly keeping my Tibber rewards. So that's impermanent gain when it goes out of range to the upside and it takes profit for you. So going here, that's my wide range. And wide range is cool because you don't make as much in APRs, but you make more in impermanent gain because you leave more room for the smart contract to take profit for you. In the small ranges, right? If I break this down, this is a smaller range. You don't make as much in impermanent gain, but you make more in passive fees. So I have them in both so I can get the best of both worlds. I've been in this one for not even a week, 6.8 days. I hopped in with 8K, so I'm up almost 2K in impermanent gain. But in less than a week, I've been able to make $625 without doing anything, just sitting here, right? Almost 1% a day right now. And it's actually more than 1% a day if you factor in how much Tibber has been rising, right? You want to look at the aggregate gain, not just the APR, because you're not earning in USDC, you're earning in assets that are going up or down. So you want to take that into account as well. Now, for the Zora pools, these things are still printing 631% APR ever since that whole Robinhood listing, dude. It's just been printing, man. And now I was able to take some of my Tibber profits that I took from my 600% gain and put into more Zora. So I've been in this position for 18.9 days. In 18 days, I've been able to earn 1,400% and around, I want to say, almost $800 in impermanent gain.
On that Zora pool, what was your initial entry? So
when I got in?
Oh, sorry. Like, how much did you put into that initial Zora pool?
Like 4K.
4K.
Yeah, 4K. So I'll take my rewards and compound them, half of them, and I'll use the other half to buy more Zora and whatever else I want to buy. So that way I'm getting 631% APR on a higher balance, and then it starts to rack up even faster. So eventually I want to grow this Zora pool to, like I did this Tibber one. I started out with like 6K, I'm up to 9. And this one I started out with 12K, and I'm up to 18.
Beautiful.
And that's not taking into account the money I made from the rewards that I was able to go and stack. Last one here, Zora USDC, 601% APR. Been in this one for 18.9 days. In those 18.9 days, I've been able to make 1,265. And I've made around 400. I got into this one on like 3,800. So I made almost $500 in impermanent gain here and $1,200 here. So almost $2,000 passively in just 19 days. It's pretty good if you ask me.
Yeah, dude. Honestly, this is inspirational. So I guess people that are looking for alpha, I know this is actually when we're talking about these pools, our numbers actually shot up quite a bit, like maybe an extra 30. We're now up to like 130 viewers. Tell us what other pools do you think are looking interesting on Base?
Well, why don't we have a look-see? So if you're bullish on Clanker, this is a good one.
I mean, Clanker's had an amazing week.
Yep, you got 3,000% APR plus. on Clinker Wrapped ETH on Aerodrome and on Uniswap, doing both pretty well. Virtuals, if you're bullish on virtuals, this one's pretty good. 1700% APR. Dude, look at this Toshi pool, man. We've been talking about this Toshi pool for weeks, bro. Look at that thing, bro. 1% fee tier. Just printing, man. Just printing. Is this Farcaster coin? Do they have a token?
There's no Farcaster token.
Okay, so it's a bullshit meme token. So never mind there. Another virtual ETH, 847%. Avantis still looking good, 632%. Syndicate, there's your baby, 1% fee tier, 500%. Another virtual pool. AI XBT, I haven't heard about them in a while. Looks like my wife is doing good. No, I'm just kidding. Here's Tibber, 460.
That's where it's at.
And then Zora, 434. And my range is tighter, so I've actually been getting more than that. So yeah, everything looking good right now.
Honestly, it's interesting to see about Toshi because, it's not meme coin season, but they must still be doing some decent volume to be able to get those sorts of returns.
Well, let me see. So remember, one, it's a 1% fee tier, so that does a lot for it. And then two, look at how low the liquidity is. It's only 288K. It's not that they're doing a lot of volume. It's just that they're doing a lot of volume relative to the TVL or liquidity. So for those of you who are just your first time watching the show, the liquidity providers, they're like Pac-Man. And the volume, you get paid off volume and liquidity providing. The volume are like the dots that the Pac-Man eats. So when you have a good volume to TVL ratio, this one's 4.1. You can see this one's 19. This one's really high. I'm not sure what ping is, but shit, ping me. No, I'm just kidding. But if you have liquidity, the Pac-Man, and you have volume that's higher than the daily liquidity, it's like it's less Pac-Man with more dots to eat. Everyone's getting full, right? But if you have something like this, let's go all the way to the bottom to the shitty yields. If you have something like this, where you have 30K, this is a Pac-Man, 30K, but the volume is actually less than the liquidity. What you have here is a situation where you have more Pac-Man and less dots. Everyone's fighting for the scraps. Everyone's hungry. So having a good volume to TVL ratio is the most important thing. It doesn't matter if it's two. It doesn't matter if it's if you don't want to get into a pool where it's like 10K in liquidity or something like that. So there is a threshold where like some kind of baseline, but it doesn't matter if it's 1 million in volume with 20 million or 1 million in TVL with 20 million volume or 100 million in TVL with 3 billion in volume. As long as that volume to TVL ratio is good and it's not some like BS meme coin pair, then you're good.
I think what you say about don't enter pools that you wouldn't hold each of the assets. I think that really holds water because as you said before, you want to have the conviction to be able to hold it through this period of time. I mean, like some of those pools you've been for multiple weeks, but that's because months. Oh yeah, months. Yeah, Tibber. Geez. Yeah, I mean, if you're bullish on the underlying asset, then you can just hold it, and if you go out of range, wait for it to get back into range. If it's on the downside, or take profits.
Exactly.
All right, man. We'll do. I feel like I need to get back into some pools this week. I've been pool-less, which it's oh man, I missed those few weeks I was printing on golden. I felt like I found like the a hidden gem there, and for that period of time it absolutely was. But the Zora train is in full swing, and Toshi. I mean, we've talked about Toshi. Virtuals. I mean, these are all like infrastructure plays, and then Toshi, the biggest meme coin on base. That's a really nice ratio. The 1% T tier, fee tier.
I like that better.
Yeah. All right, man. Well, dude, any final words or calls to action before we put a nice bow on this?
No, I would just say we'd love to have you guys join our free community. We're making some good money here, getting set up for our blow off top, and most importantly, making sure we're getting set up for the next bull market. It's not about how much you make, it's about how much you keep. And if you can take some good profits off the table for this bull market, you'll be able to go discount shopping during the bear market, which I like to call Black Friday. And to you, Basejunkie, I would say throw on them swimming trunks and hop back in some pools, man, because it's plenty of water, baby.
That's it. The water's warm.
It's warm. It's warm and it's cycloning.
All right, man. Well, I need to remedy that. So I will hit you up in the DMs. I might even get into one of those Toshi pools. Like, I don't know. Like it's not meme coin season, but
I'm tempted.
I mean, like meme coins, I think they're gonna have a run again. I mean, like I'm holding Ski Dog, and that's
when the base app goes live, the #1 base app, it could run with a blow up top. I wouldn't be surprised.
Yeah, man. Anyway, food for thought. All right, so I want to say a big thank you to you for all the prep you do before the shows, all the alpha you drop, and all the inspiring yields. A big thank you to the 180 people who tuned in today. We do these shows every Wednesday. Anyway, we'll see you again next Wednesday for the next episode 11 of Our Eyes on Base DeFi. Until then, stay safe, stay healthy, but most importantly, stay based.
Peace out, y'all.